Investing is all about balancing risk and reward. Just like swimming, some people are comfortable in deep waters while others prefer staying in the shallow pools. What makes the difference? Risk tolerance. In this video, we'll discuss what is risk and why it matters, the importance of taking risks for your long-term wealth creation, how to effectively manage risk using a framework, how different financial goals impact your risk level, why equity investments are a key to long-term growth. By the end of this video, you'll understand how to balance risk and reward in your own investment strategy. Now let's look at what is risk and why it matters. Risk in investing refers to the possibility of losing money or not achieving the expected returns. But the level of risk that is acceptable is different for everyone. It's based on two primary things. Your own risk capacity. This is about how much risk you can afford to take, which is based on different things like your financial situation, your income, your age, your financial obligations, etc. etc. Secondly, we come to risk tolerance. This is about how much risk you are comfortable with emotionally. Even if your risk capacity is higher, you might be only comfortable with a lower level of risk tolerance. A person nearing retirement may have low risk tolerance even if they can afford to take a lot more risk. Understanding both your capability and tolerance for risk is the first step and is essential to make your investment decisions align with your financial goals. Nextly, let's look at why should you take risk. Now, you might be wondering, why should you take risk in the first place? Why not park your money in a fixed deposit and be safe? The simple answer is higher returns often come with high risk. If you play it safe with assets like savings account or fixed deposits, your money may not grow enough to beat inflation. Inflation reduces the purchasing power of your money drastically over time, making it much less valuable. For example, let's say you invest 10,000 in a savings account earning you 3% annual interest. After 10 years, your money grows to 13,400. If inflation is around 6%, the real value of the 13,400 will be much lower. In contrast, equity investments, it may be stocks, mutual funds, etc., are riskier but can generate their higher returns that either keep up with inflation or beat inflation over long time. So while risk can be scary, it's necessary for growing wealth, especially for your long-term goals. Now, let's look at how to manage risk effectively. You can't avoid risk completely, but you can develop a framework to manage it wisely. Here's how. First, diversification. This means spreading your investments across different asset classes like stocks, bonds, real estate, and gold. This way, if one asset class underperforms, others can help balance the risk. Secondly, asset allocation. This is about deciding how to divide your investments across riskier assets like equities versus safer assets like bonds. Your allocation should align with your goals and time horizon ideally. For example, if you're young and saving for retirement, you can afford a much higher equity allocation than someone who's closing on retire. Thirdly, the magic tool, systematic investment plan or SIP. You guys must have all heard of it. SIP in mutual funds are a great way to average out a market. This reduces the impact of market volatility and averages the cost of your investment using rupee cost averaging over a long period of time. Fourth, rebalancing. As your life circumstances change, your portfolio and the mix of your assets should change to align with your goals as well. Now, to kind of summarize all of this, your level of risk should depend on your financial goals and time horizon. Just to give you guys a very short example, let's say your goal is short term, let's say 1 to 3 years. So in this case, you should be sticking with safer instruments like fixed deposits, maybe debt funds and things like that. In the case that your investment horizon is medium term, 4 to 5 years, you can go for a combination of maybe debt, equity and gold. And if your investment horizon is long term, let's say 7 years, 10 years, 15 years, then equity can play a very, very big role in getting you to that goal and making sure that you are able to sustainably create wealth towards this goal. Your investment horizon directly impacts how much risk you can afford to take. The longer your time frame, the more risk you can afford to take. Now, let's look at why equity? Why is it so crucial for your long-term goals? Equity is essential for long-term growth. While it may be volatile in the short term, it offers the potential for higher returns that can beat inflation and help you build wealth over time. Here's why it is as crucial building wealth as well. Here's why it is very crucial in building long-term wealth. Here's why it is very crucial in building long-term wealth. The power of compounding. Equity investments benefit from compounding, the process of reinvesting your returns which help grow your wealth exponentially over time. Secondly, and more importantly, inflation protection. Stocks tend to grow faster than inflation, so you're not just preserving your purchasing power, but increasing it over time as well. Long-term growth. Despite market fluctuations, the stock market generally tends upwards over decades. Equity investments are essential for goals that are far in the future, like retirement or maybe saving towards buying a home in the next 10 years, because they offer the best opportunity for growth. In short, if you want your money to grow significantly over the long term, equity is your best bet. Not taking enough risk early can lead to insufficient funds for retirement or other major life goals. To conclude, risk and reward go hand in hand. The key is understanding your risk profile and managing it wisely. If you take too little risk, your wealth may not grow enough. If you take too much risk, you could lose more than you can afford. Now, striking the right balance is where we come in. We can help you craft your own goals, craft your own financial plans, and make sure that risk and reward are aligned. So, what are you waiting for? Get in touch with us through the link in the description, and we'll be more than happy to assist you.